Hey everyone, welcome back to Corporate Decoder. Today we're diving into a document so long it's practically a novel. But don't worry, we'll extract the juiciest bits. Get ready for potential mergers, shifting markets, and a company trying to convince investors it's not just another empty shell. Let's talk about WinVest Acquisition Corporation. They're trying to merge with Xtribe, a platform that wants to connect buyers and sellers locally. Think of it as a hyperlocal online marketplace. But the road to this merger is paved with paperwork and potential pitfalls, and we are here to decode it for you. First things first, this is amendment number 1 to their registration statement, meaning they've already had to tweak things once. That's not uncommon, but it's a sign that things can be complicated. WinVest is holding a special meeting for stockholders to vote on this deal. They need approval for a few key proposals. One is changing their home base from Delaware to the British Virgin Islands. Sounds exotic. The second is approving the actual business combination with Xtribe. And the third is okaying the issue of new shares, which is necessary for the deal to actually happen. There is also the ever-important adjournment proposal, which is asking for permission to delay the meeting if they don't get enough votes. This gives them an escape hatch. WinVest board thinks this whole thing is a great idea, so they are recommending you vote yes. They're in a bit of a time crunch too. See, WinVest is what's called a SPAC, and SPACs have a limited amount of time to complete a deal, or they have to give the money back to investors. WinVest had some issues with NASDAQ, a stock exchange, and actually got delisted because they didn't get a deal done fast enough. They're now on the OTC markets, which, let's be honest, isn't exactly prime time. So what does WinVest's sponsor get out of this? The sponsor is basically the group that put WinVest together. Well, they bought a bunch of founder shares early on for a super cheap price. If the deal goes through, those shares become way more valuable. Plus, they get reimbursed for a bunch of expenses. WinVest needs office space, right? Well, they pay the sponsor $10,000 a month for that, and as of this filing, they owe them hundreds of thousands. Finally, the sponsor has given loans to WinVest worth millions. It's a good thing there are enough assets. So that's a lot of ways for the sponsor to make money, even if the deal isn't a home run for everyone. There is a potential conflict of interest. Here's the potential kicker. Current WinVest stockholders will own only around 22% of the new company, and if lots of people pull their money out, they could end up with even less. Now we get to the potential sources of dilution following the consummation of the business combination. So they're saying even under the worst case scenario, this still might work out, but let's be real. Maximum redemption means not a lot of money for the new company to actually do anything, and a lot of people get to walk away with money. Let's switch gears to Xtribe, who's looking for a successful deal. They are not in a great place. The auditors are not super excited with the financials, so this can be a way to get in the public market. Wides, the auditors themselves are worried about Xtribe's ability to stay afloat. That's never a good sign. It suggests they are worried about the operations. They have never made money, so there is also the question, will they ever be able to? Xtribe needs cash, plain and simple, and the clock is ticking. They are also relying on management, so if those people leave, it could be fatal. Now, why does WinVest like Xtribe? Apparently, it's the best available opportunity, and they think Xtribe has a cool technology. They determined that an implied value of 10-to-1 as MRs appropriate based on the RC units. Per new WinVest units in WinVest's initial public offering, Enrico Dal Monte, the CEO of Xtribe, will own a decent chunk of the new company, but not a controlling stake. There is risk of diluting current shareholders. One more thing to note, some key people in Xtribe are located outside the United States, so there's added risk of it being difficult to recover losses. This is where we see the potential future financial situation, but as they say themselves, this is just a what-if scenario. There are a lot of things that they cannot predict. Let's talk about ownership. This number shows how the existing security holders of WinVest common stock will see their positions diluted after the transaction. The table indicates that WinVest management will own a large percentage, around 16.6%, comes in the new company regardless of redemptions. Looking at the dilution here, there is a big difference depending on whether or not people take the warrants and shares that are being offered. This is a huge thing to account for. Speaking of which, here's a major point. There is over $4 million in outstanding private placement warrants that can be purchased for 0.50, and each people chose to exercise them, more dilution might occur if more shares are added for cheap, and increased risk due to more shares being easily available, making your ownership worth less. Finally, management will have broad discretion. It's a good thing if you believe in them, but if not, it is a bad thing. So what's the corporate decoder take on all this kiasa? New WinMe needs money. Xtribe has a long road ahead to become profitable. Even if the technology is great, they are in a very competitive market. As for the WinVest side, the sponsor is likely to make money no matter what, but for public shareholders, this deal is a big gamble. Lakes are not a financial advisor, so do your own research before investing. If you found this breakdown helpful, please hit that like button, leave a comment, and subscribe for more corporate decoder deep dives. Thanks for watching, and I'll see you in the next one.